This video is going to cover the last of the financial ratios which relate to efficiency, and there are two efficiency ratios, that being the expense ratio and the accounts receivable turnover ratio. So what's efficiency? Well, it's the ability of a firm to use resources effectively in ensuring financial stability and profitability. So those resources we're talking about really are those expenses in relation to the business. And as I've said, there are two of those key ratios. So what's the expense ratio? Well, it's a measure of what percentage of sales are being taken up by expenses, or operating expenses, or all expenses of the business divided by sales. And again, it's expressed as a percentage because it's times 100. It relates sales figures to the expenses incurred in making those sales. And here's an example. So we've got I Wish Toys. They've got expenses of $111,800 down here. Their total expenses, their operating, general, and financial expenses, divided by their sales of $630,000, mean they have an expense ratio of 17.7%. Again, like all the other ratios that I've been talking about, that really doesn't mean anything unless we have a look at, okay, what was their expense ratio last year? What's the industry average expense ratio? What are their competitors doing in terms of expense ratio? Because that looks relatively low, but you don't really know until it's compared to other similar businesses or time periods or an industry average. The accounts receivable turnover ratio is a really important ratio because it's really measuring the efficiency of a business to be able to collect its outstanding accounts receivable. And there's a two-step process to the accounts receivable turnover ratio, which needs to be understood to convert a figure into a number of days. So how is it measured? Well, firstly, take sales and divide that by the accounts receivable that business has, because those accounts receivable are a small percentage, or hopefully they're a small percentage, of the total sales that have been made. So of these sales that have been made, some of those sales, the money for those sales has not yet been received, and that's what you're trying to work out. And that answer there to that first part of the equation gives you the number of times a year that the debtors are getting turned over or collected. So the number of times that those accounts receivable are being turned over per year. Now, a business would want to have a high accounts receivable turnover ratio, because that indicates that they are they're collecting their accounts receivable many times a year, which is much more preferable. And it means that they're collecting those accounts receivable in a relatively short period of time. So they're not, taking 60, 90, 100 days to collect them. Hopefully, they're doing it in 7 or 14 days, collection of those accounts receivable. Now, once that answer is determined, you then divide it into 365 to determine the number of days on average it's taking that business to collect its debtors or its accounts receivable. And again, the business would want that answer to be as low as possible. Like I said before, to equate to a 7-day or a 14-day accounts receivable average accounts receivable period. The importance of the ratio, well, most businesses sell on credit, at least to some degree, and so it's an ability to collect debts. The ability, to collect debts is really important, and those debts we're really talking about are accounts receivable. So the ability to chase up those outstanding invoices and receive payment for them quickly. And also that means that the business has got the money in its bank account as opposed to it being in the bank account of its suppliers or of its customers. A generally accepted effective accounts receivable turnover ratio, or rate I should say, is 30 to 60 days. So on average taking 30 to 60 days, although 60 is getting towards the high end. Most businesses, when they send out an invoice, they say please pay within 30 days. So that's generally a sort of a rule of thumb. Okay, so here's a worked example. We've got our accounts receivable turnover ratio. So sales over here of 630,000 divided by an accounts receivable of 25,000. That means that this business has an accounts receivable turnover ratio to start with of 25.2. So that means 25.2 times a year it is collecting on average these accounts receivable. So that's pretty good. Then to get into a per days, it's 365, so the number of days in a year obviously, divided by how many times a year it's turning over its accounts receivable, 25.2, which means that they get an answer of 14.5. What does that 14.5 mean? It means that on average it's taking them 14.5 days to collect their accounts receivable. And given on the last slide I said somewhere between 30 and 60 days is considered to be quite acceptable, this business is definitely at the lower end and it's doing very well, and you would say this business is very efficient. It is collecting its accounts receivable very quickly and therefore it is operating with a high degree of efficiency, and that's ultimately going to assist the business to be very profitable. So that's it for financial ratios. The next video will look at the comparison process and comparing them over time periods against standards and with different businesses.